I'm going to be talking to Chris Severson Baker, who is the Pembina Institute Regional Director for Alberta, about a new report called Getting on Track, a primer on challenges to reducing carbon emissions from Canada's oil sands. So welcome to the interview, Chris.
Thanks for having me again.
Now, I've interviewed you about this before, and Energy Media has been reporting on oil sands GHG emissions for a long time. And this issue never goes away, but it sounds like it's going to be, the conversation is actually going to be intensified because of the coming federal government oil and gas emissions cap and the need to do something quick so that we can meet 2030 climate targets.
Right. And we're in a situation now where we've got oil sands companies who have pledged to achieve carbon neutral by 2050. They have laid out a pathway to get there. It's not credible in the sense that it clearly would get you all the way to net zero by 2050, but it does call for some pretty substantial emission reductions in the first 10 years, so by 2030. And now what we see as being very necessary is for the government to respond to that and say, okay, well, here's the cap and here's the requirements that are going to result in those emission reductions becoming real between now and 2030. And then there'll need to be more work to figure out, well, how is the oil sands industry actually going to achieve its full net zero ambition after that?
Right now, you're calling on, or Pembina is calling on the oil sands sector to lower GHG emissions 40 to 45% by 2030. Thus far, the only producer that's committed to cutting its emissions by then is Suncor, which is going to reduce emissions by 10 megatons from its current 29 megatons. And when I read that Suncor's press release, I couldn't help but ask the question, why can't the other producers be doing that?
Right. And of course, that is what is going to be absolutely necessary. Otherwise, Canada will have no hope of achieving its target for the whole economy. So, Suncor has sort of stated the obvious, that that's the direction that we need to go in. The other companies haven't done the same. But they did, as a whole, they proposed about 22 megatons of emission reduction by 2030 in their overall pathways vision statement. And that's not 45%, but it's a pretty big emission reduction in a relatively short period of time from a sector that requires large capital investments to get those kind of reductions. And so we think that that's a reasonable amount at a minimum to get from emissions from the oil sands sector, and that other emission reduction possibilities exist in the upstream oil and gas sector that can be acted upon faster. And so that overall the industry could achieve 45% or more. And we think that's critical because, this is the big source of emissions in Canada. This is where the emission reduction possibilities exist. And Canada is only going to achieve its target if the oil and gas sector is pulling that kind of weight.
Right. And we should point out that the oil sands all by itself accounts for 11% of Canada's national emissions of 730 megatons a year. So it's approximately, the oil sands are around 80 megatons a year. Mm-hmm. Where these emissions reductions that you're talking about, where the industry is committed to, I think it was 25% or so, where are they coming from?
Some of them are from continuous improvement in terms of energy efficiency. Some of them are coming from fuel switching, so getting away from burning coke to burning something that's less carbon intensive. There's some carbon capture and storage, targeting some of the easier to capture sources, so the so-called proven CCUS projects. And that's about as far as they've gone, at least in that sort of initial time period. There's a number of other technologies that they're looking at for sort of the 2030 to 2040 and beyond kind of time period.
Now, one of the points that I think has to be made is that consultancies like Wood Mackenzie, for example, are forecasting that because of chronic underinvestment in exploration and production globally, that prices are likely to remain high throughout the 2020s, And I know I interviewed one of their executives, and he called it the last great oil boom. So oil sands producers are expected to make, record revenues, and very healthy revenues all through the 2020s. And this seems to be the perfect time, when they have spare cash, to get them to invest it in lowering their emissions.
Absolutely, and it's already happening. We've seen for several months now, we've seen companies reporting pretty significant revenues, and at the same time, though, we're not seeing them making investment decisions in big decarbonization initiatives. They're sort of doing the same types of things that result in lowering the cost of production, right? So they continue to make progress on those things, and some of those things do result in some emission intensity improvements, but it's not significant from an overall GHG perspective. And so really, what we're in a situation where they've signaled that they can do it. The market conditions are favorable to do it, but they're not actually going to do it unless they're mandated to do it. And that's the role of the federal government with the emission cap. Whether the federal government does some kind of a escalating carbon price, or whether they actually implement some kind of a trading system, regardless of the mechanism, it's going to take a mandate from the federal government to do that.
Yeah, this seems like I have to tell you, I mean, it looks it's very interesting, because the companies can do it, they can afford to do it. They've signaled their intent to do it in the long term, if assuming that the government, some level of governments comes forward with $50 billion to fund their CCUS projects. But their urgency is the thing that seems to be missing.
Mm-hmm. Yeah, and I think, partly it's, they're not going to do it unless they know that they have to. Part of it is, a big part of it is, even though we have an escalating carbon price, that price is not considered to be certain in the future, because again, another government could come along and decide that we're not going to actually implement that escalating carbon price. And so, and they do need to turn to banks and lenders to get the kind of capital, even though they have strong revenue streams, to be able to finance some of these projects. And it's hard to convince those dollars that, that the project has a strong economic foundation and that it's required, and so on. Same thing for their investors, or the shareholders. Like, why wouldn't you just give me dividends if I'm a shareholder? Why would you be putting money into something that you think might be required in the future? Like, I need to know for sure that it's a requirement. So there's definitely a role for government here, and I think there's also a role for the Alberta government too. Like, we're talking about the federal government mandating emission reductions, but the provincial government has done a lot of created a lot of uncertainty about where it's planning to go with its own climate policy, and by resisting, it casts doubt on what the federal government or the whole country is going to do, and all of this uncertainty is leading to a lack of investment. So just having a clear plan, in Alberta that aligns with that federal plan would be a big step forward. And then maybe something else needs to be done where the government says, you know what, we're willing to guarantee these prices are going to go up. And if they don't, we'll compensate you. So the so-called contract for difference kind of approach to making sure that companies are able to invest in decarbonization projects with certainty that the price will be there at the right time.
Well, you mentioned the provincial government, and the industrial emitters carbon pricing of course, falls in their bailiwick, even though they negotiated an equivalency agreement with the federal government. Nevertheless, there is a discount applied to that carbon price of, I think it's $50 a ton now. There's a discount of 80 to 90% applied to it. And in fact, I think last year, Suncor paid an average of like $2.50 a barrel.
Right.
They pay a pittance on the carbon price. And it seems like the low hanging fruit in this debate is to lower the discount.
Exactly, right. Or another way of thinking about that is to more of the emissions, are actually facing the carbon price as it goes up, as opposed to only a fraction of them. And that's really what the opportunity that the government has in the short term to start sending the right kind of signal, to start getting the early emission reductions to start getting investment decisions moving, regardless of what it decides to do in the long term with a cap and with whether or not it does a trading system and that sort of thing. And you can see it very clearly that this, what you're describing is when companies spend a lot of time reassuring investors that the carbon price actually doesn't have that much of an impact on their operations, and that they don't even foresee it increasing significantly in the near future or affecting their investment decisions. And therefore, the reassurance to the investors is you're going to keep getting growth in dividends and things like that. So clearly it's not, it's the system's in place, but it's not actually doing what it needs to do. But there's a lever that can be pulled.
Right. And I think it's increasingly important that it be pulled because of the forecast for 650,000 barrels per day of supply to be added from the oil sands by 2030. So it'll be going up close to I think it's 5 million. That'll pay about 5.75 million barrels a day. 4.75 million barrels a day. And even though the emissions intensity has fallen over the last 20 years, it's that increase in supply that always undoes the good that comes from those intensity reductions.
That's exactly right. Yeah. And, I think the other thing that we haven't talked about yet is sort of what this happens for, this is going to happen for a period of time, right? Where we're going to see these sort of previous investment decisions continuing to play out in terms of production. You're going to see there's emission reductions that can be achieved at very low cost, relatively speaking, between now and 2030. And then two things change in, around 2030. Like the demand for the product globally is expected to start to decline because ZEV mandates and other types of things will really start to kick in by then. At the same time, the cost of reducing CO2 will be higher because we will have done the low-hanging fruit type things. And so that's where we start to get into a scenario where you can expect to see some of the projects that don't have very good economics starting to look at wrapping up their operations maybe a few years earlier than they otherwise would, and we'll actually start to see some emission reductions as a result of that business decision.
And one of my takeaways from your report, Chris, is that pressure on the federal and provincial governments to deal with this, pressure on the companies to deal with this is really important. This can't be, decided behind closed doors, and some of the compromises on policy that we've seen in the past maybe shouldn't be on the table this time around.
Yeah, especially, especially like there's always been a bit of an attempt to sort of let's maintain production at all costs. We'll only do as much, and we've seen this with environmental policy in North America for decades, right? Like even with other cap and trade type systems that were put in place to deal with acidifying emissions, there was always special provisions for the certain sector of the certain segment of the industry or the sector that couldn't really afford that type of economic cost. We really can't afford to create exemptions and that sort of thing in a system like this, or we're just simply not going to achieve the ultimate goal of the emission reductions.
Well, Chris, always a pleasure. Thank you very much for your insights.
Thank you. Look forward to it again.